Welcome to Alu Speaks with Alu Patience. Today we'll be discussing the topic working capital. This is our first topic on Module 3 in the course Corporate Finance. If you have not watched our previous topics, I would advise you to do so. I am aware that most of us here do not have a business-oriented background. However, do not worry. I'll be breaking the course down to be as simple as ABC. At the end of today's topic, we should be able to explain the meaning of working capital, highlight the trade-offs on working capital, and state the costs and benefits of holding cash and inventory, and also explain the determinants of a firm's credit policies. Before we dive into the topic working capital, let us first refresh our minds on some of the items that make up our working capital. These items I'm talking about is our current assets and our current liabilities. What are current assets? These are assets that can be converted into cash within 12 months or within one operating cycle. They are short-term assets. They include items like cash at hand, that is money we have at the counter. Cash at bank, that is money we have already deposited at the bank or has been deposited at the bank on our behalf. Account receivables, that is money owed to us by our debtors. That is customers who haven't paid us for our goods and services. We have inventory, that is money we invested in goods for future sales. These goods can be raw materials, intermediate goods, and even finished goods. We sometimes call them inventory and sometimes we call them stocks. Another one is the prepaid expenses. This is money we have paid in advance, but we are yet to receive the services, like our prepaid rent, our prepaid electrical bills, NEPA, our prepaid insurance premium. We have marketable securities. These are debt investment, like our treasury bills that we can sell at a later date at their market value. And we have other short-term investments and other short-term bills receivables. Now, what are current liabilities? Current liabilities, they are liabilities that we must pay up within 12 months or one operating cycle. They are short-term liabilities. They include the account payables. That is money that we owe to creditors, that is our suppliers, for inventories purchased on credit. Tax payable to government that we have not yet paid. Interest on loans that we fall due within 1 year. Even loan principal that was once a long-term liability but we fall due within a year now becomes a current liability. We have deferred revenue, that is advance payments from customers for goods and services we have not yet delivered to them, that is for future services. We have accrued expenses, that's our accruals. That is money owed for services we have already received, but we are yet to pay for them, like our accrued wages to our employees, our accrued rent to our landlord. Please note, accruals are money owed for services, not for inventory, like account payables. Bank overdraft, that is money owed to the bank that will fall due within 1 year, and other bills payable. The reason why I took my time to itemize some of these current assets and current liabilities is so that we can easily recognize them in the balance sheet. So from the lens of a businessman, we can see that current assets are those assets we spend our money on, but we can get our money back within 1 year. And current liabilities are those items that we can delay spending our money on, but we still have to pay for them within 1 year. This is what led to the topic working capital. By working capital, we are trying to balance what we must spend money on currently and what we may not pay for currently, so that we can have enough money in our wallet to meet our day-to-day operations of our business. This means what we are saying here is that working capital is simply our current assets minus our current liabilities. Working capital is simply the difference between current assets and current liabilities that is available to run the day-to-day activities of our firm. Working capital can also be called net working capital. That means if we have something like net working capital, it means we also have something like what? Gross working capital. But let's not go into the various types of working capital. Let's keep this class light, make we no go burst our brain. However, let's do a little practical with the sample balance sheet before us. We can see the current assets of cash, account receivables, prepaid expenses, and inventory totaling 185,682. Going down, we can also see the current liabilities of account payable, accrued expenses, and unearned revenue totaling 6,762. Therefore, our working capital is simply what? Current assets minus current liabilities. That is 185,682 minus 6,762, which will give us 178,920 as our working capital. So from the discussion we've been having so far, we already know that working capital is crucial to our business because we need it for managing the daily operations of the business so that we can meet up with our daily obligations and so that the business can also meet up with the short-term liabilities as they fall due. If we have enough working capital, it ensures a smooth and efficient flow in the operation instead of needless breaks caused by lack of working capital. And if we have enough working capital, when we see opportunities for growth, we can actually seize those opportunities and cash in. And this would increase the growth of the company and improve our financial profile in the eyes of our stakeholders. We need to know the optimal amount of working capital we need to run our business. Because if we don't have enough working capital, we cannot meet our day-to-day obligations. And we will not end up needing external financing to meet our day-to-day obligations. But if we have too much working capital, this will reduce our profits because we end up holding idle funds that we could have used elsewhere profitably. This leads to a trade-off because now we are being forced to compare the sacrifices and benefits between liquidity and profitability. And you will ask, how do we know the optimal working capital we should keep? There are two ways to ensure optimal working capital. This can be either through ratio analysis or through the management of the individual items that make up our working capital. What I'm trying to say here is that working capital management helps us to ensure that the company has sufficient cash flow to meet its short-term obligations and operating expenses. How much working capital should a company hold? This varies from firm to firm. By asking how much capital should a company hold, we are asking what are the factors that determine the level of capital a firm should hold. This depends. It depends on the nature of the business. Manufacturing firms may likely hold more working capital than service firms. It also depends on the size and growth of the firm, as larger firms and expanding firms will require larger working capital. It also depends on the length of the operating cycle of the firm. That is the time frame it takes to convert the purchase of raw materials into manufacturing, into sale, and into receiving cash. The credit policy of the firm also plays a role here. Firms with liberal credit policies to customer will need higher working capitals than those with strict credit policies. It also depends on how the firm manages and control its inventory. And firms with easy access to bank loan may likely hold less working capital than firms that do not have access to those bank loans. So from what we are seeing, working capital of a company should only be increased if the benefit of such an increase exceeds the associated costs. Normally, an initial increase in working capital may lead to an increase in the value to the firm. But when the marginal benefits being derived from such increase in working capital starts to decline, such working capital should not be further increased. We previously said that one of the ways of managing working capital, apart from using a ratio analysis, is to manage the individual items that make an impact on the working capital. So let's discuss some of these individual items that we can manage. Let's start with cash and cash equivalents. Cash management is the process of planning, controlling, and monitoring your company's most liquid assets to ensure that you have enough to meet your obligations, but not too much, so that idle cash will be sitting in your hand instead of making profit for you. When we say cash, it includes our physical cash, our bank balance, and our demand deposit. And while cash equivalent are those your short-term investments that has a maturity date of 0 to 3 months, such as your treasury bills and your commercial papers. Holding physical cash doesn't actually earn any return, yet the company still suffers cost of opportunity forgone. What do I mean by this? By holding physical cash, you have lost the opportunity of investing that cash in something that would have given you a profit. However, such cash that you hold at hand, it makes cash easily available to settle obligations at a moment's notice. That is why instead of most firm holding physical cash, they rather hold cash equivalents, that they rather invest their cash in short-term investment that they convert to cash very fast, because it's as convenient as holding cash, although not as spontaneously available. But the beautiful thing about cash equivalent is that you earn a return on it. And we have to ensure that the return we earn on our cash equivalent is higher than the cost associated with such cash equivalents. What we are simply saying here is that cash management is about balancing the cost of cash and cash equivalents against the returns of cash and cash equivalents. So why do we really hold cash? So as to meet our day-to-day running of the business and to be able to meet unexpected contingencies as they may arise. We also hold cash so as to be able to take advantage of profitable opportunities. Example is when we see an opportunity to buy raw material at a discount. Another reason for holding cash is that sometimes it is a requirement, maybe a requirement by your bank or your credit facility to have a minimum balance in your account. We know that inventory is a list of items that a company owns so that it intends to sell or use in the production process. Such inventories can either be goods or they can be services. And inventory comes in different forms. It could be raw materials to be put into the course of production. They could be work in progress. These are inventory already in the process of production. They can even be finished goods. That is inventory that are completed and ready for sales. Inventory can even come as supplies. That is, these are items that are used in the course of production, but they are not part of the product being produced, like your lubricant, your fuel, your bolts and nuts, replacement parts that you use to replace your equipment and machineries that you use for production. For financial institutions or organizations, their own inventories could be all these marketable securities. So inventory management is all about planning, controlling, coordinating the acquisition, storage, movement, and distribution of inventories, of different types of inventories. so as to meet the demands of your what? Customers. What I'm trying to say here is that the objective of inventory management is to strike a balance between the amount we invested in inventory and our customer service. So what are the main reasons for holding inventory? So as to meet our day-to-day expenses, so as to meet our day-to-day sales, that is transactionary motive. We also hold inventory to buffer against uncertainties and of stock out. What I'm trying to say is that it can act as a buffer, as a precaution against stock out. We also hold inventory in order to be able to take advantage of a future change in price. You see some of our petrol stations in Nigeria, when there's a speculation that fuel price will soon increase, you find out that they do what? They hold on to inventory, expecting that future price change so that they can cash in on it. Another reason, especially in a manufacturing company, is to ensure continuous flow of production so as to prevent stoppage. Because when there is not enough inventory, there may be a stop in the production process. People also hold inventory because they rather buy in bulk so as to benefit from a quantity discount and to lower ordering costs. But how do we manage our current liabilities? These are techniques we put in place to reduce our current liabilities. For instance, like taking advantage of a supplier's credit terms, or using our current liabilities to finance our current assets, and not using our long-term liabilities to finance our current assets. Another way is for us to monitor our accrued expenses so that they don't over accumulate, like on our unpaid taxes or unpaid salaries. We try our best not to allow them to accumulate and be beyond the ability of our current assets to settle them. We can even renegotiate payment terms with our creditors, like asking for an extension of payment period. So you can see that one of the main reasons why we have to manage our current liabilities is to prevent the loss of our suppliers' trust in us, and to prevent penalties, interest charges, and even insolvency. Even our debtors need to be managed. That is our credit policy management. By credit policy management, I mean policies we put in place that will help us to decide the amount of trade credit we are willing to offer our customers. This is the level of risk a company is willing to take in order to offer credit to its customers. The factors that determine the type of credit policy or the determinant of such credit policy, it includes the percentage of credit sales as compared with total sales in the company. It is influenced by the quality of the customer that we are offering credit, the collection policy, and the terms of the credit we are offering to our customers. Sometimes we may need to do a credit analysis in order to understand the level of credit to offer. But we really have to compare the cost and benefit of doing that analysis compared with the level of credit we intend to offer.